Good afternoon, everyone, and thanks again for joining another Barometer webcast. I'm Pamela Hastings, Relationship Manager here at Barometer. Joining me today is David Burrows, our Chief Investment Strategist and President at Barometer, and we have a special guest star, Diana Avador, our Head of Trading, who's going to be discussing news out of the Fed and what she's seeing in terms of fund flows across the trading desk. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you? It's good to see you. And hi, Diana. It's great to have you on the call today.
Hello, everyone. Thanks, everyone, for joining. Thanks for having me.
So, Pam, you've got to send us some of your warm weather because it's a little chilly here in Toronto.
Yes, please.
I've heard, but it's just around the corner. It's a steamy 94 degrees down here in South Florida. But looking forward to coming across the border July 5th and back up to Canada to enjoy the summer.
Well, we'll be glad to have you.
Nice.
So lots to talk about today. We're going to move fairly quickly. It was a big week last week. Markets moving around, some counter trend moves, both up and down. It was an important week. The Fed was on deck and obviously an important speaker in light of the fact that there are concerns around inflation versus reflation. And also there was a very large options expiry on Friday that probably added a little bit of volatility to markets. But we're gonna sort of take it from the top. I'm gonna ask Diana to come in shortly and just give us her take on some of the things that took place last week. So just to kick off, as we always do, we continue to believe we're in an equity secular bull market that started in 2013 in U.S. equities. That was probably the leading equity index globally, and it's been working its way higher in fits and starts. But that certainly continues. When we look at the bond market, we think we've been going through a generational bottoming in yields, which is an important thing to keep in mind from a positioning standpoint, because certainly the things that worked well during falling rates may not be what works well in a reflationary environment as long rates slowly go higher. And then importantly, over the last year, I think we went through a secular bottoming in commodity prices. And we know that once commodities start to outperform, they can outperform for a very long time. And it's an important, market and sector, certainly for our home market here in Canada, but other global markets around the world. So these have been sort of important themes for us to focus on. And we kind of want to touch on those as we work our way through. So just starting out with the S&P 500, because it's such an important index and barometer that people take a look at. It's been steadily climbing once it came out of the little double dip pullback last September, October. And we've been in this channel fairly steadily all the way along since then. We've come down several times and tested the low end of the channel. We've tested the upper end of the channel a few times. And here we are sort of having touched on the low end of the channel last Friday and back working our way back higher again. So look, it's an important concept to keep in mind that in a bull market, it is typical to see steady advances punctuated by short, sharp pullbacks. And the reason they call it a bull market is it's trying to shake you off. And I have posted on the top of my Twitter feed at Barometer CA that says the hardest thing to do in a bull market is to stay in your winning positions. And the hardest thing to do in a bear market is to be a good seller. And so if we're in a bull market, we are going to have shakeouts. We are going to have counter trend moves. And the question is always going to be asked, as we were asked again last week by many people, is the market going through a shift? Do we need to change positioning? So we're going to talk about that on the way through today. If we take the NASDAQ consolidated really from March or the late February through into this past week when we took out those highs. And while markets in the S&P and the Dow were a little sloppy, NASDAQ actually acted pretty well. So good to see the growth stocks participate. Again, talking about the concept of a healthy market, we should see a broadening in the market. We should see more groups participating, not less. And it doesn't strengthen one group, doesn't have to be at the expense of another. You can see lots of different stocks and themes and sectors rally at the same time. So good to see growth re-entering the picture and acting a little bit better. When we look at commodity prices, this is the equally weighted Rogers Commodity Index across all basic commodities. We saw the structural bear market that took place from 2009 through the early part of late part of 2020. We have had 1, 2, 3, 4, 5, 6 months since we broke that downtrend. We continue to make higher monthly lows, and that is constructive. Although, commodity prices did pull back a little bit over the last couple of weeks. We're going to examine that. Now, here's the bond market. This is the long end of the U.S. Bond market. This is the TLT ETF. It's made up of bonds that are 20 years plus in duration, issued by the U.S. government. This was the peak last year in TLT pricing at 177. We sit at 143 today. And you can see along the way, we were making successive lower lows and lower highs. And we have had a rally since March, where the bond moved from about $133 to about $143. Last week, we talked about the fact that we were approaching the downward sloping 150-day moving average, which is just a smoothed average of the last 150 days of price. And this is the trend. And the trend is a weak one. It's been falling in price. And now I said a bear market is a steady dripping decline punctuated by short, sharp advances. And those short, sharp advances always will catch some investors to say, well, maybe we've bottomed, maybe I should jump on board. And often after a week or two of strength, sort of the bottom starts to weaken, and we'll see whether that takes place. We certainly ran into that moving average and have pulled back from there. But it was very confusing, I think, for a lot of folks, because as I mentioned, last week was the Fed meeting. The Fed was going to have to address, is inflation picking up more quickly than they expected? Are they going to have to change their policy? Are they going to have to raise rates sooner? Are they going to have to taper their bond purchases? And certainly, the Fed was a little more hawkish, or signaling that inflation maybe has come up a little quicker than they expected. But surprisingly, on those comments, the yield on the 10-year bond started to sell off. And for the next 2.5 days, yields moved lower. We moved from 158 on a 10-year bond down to just over 1.43. And that was confusing, I think. And Diana, I asked you to come on today because I thought maybe you could make a little bit of sense for why maybe the market acted a little bit unpredictably on that, and what other things we should look at to take away an answer.
Okay, thanks. Yeah, there's been some confusing moves and quite volatile. So just the setup. Last week was a week that was expected to be with lots of fireworks. We had the FOMC, and we also had a very, very big quad which is when all the options and the futures, they all expire. And it was very, very big. And we can go into why that was so big. But bottom line is that the reason it was so big was because there's a lot of participants in the market. So lots of people holding options, lots of people, having futures and so forth. So it was very big, and there was lots of activity around that. And then, of course, there was also the FOMC, much awaited Jerome Powell to speak. Everybody is very, very worried or want to see this Goldilocks situation continue, because that's where we are. We're in a bit of a Goldilocks situation where rates, we've seen the generational lows that, like you said, and things are getting better. And, things are getting better means rates should move up, and rates moving up is a bit of a high class problem to have, at least at this level, which is not impactful to markets until they go much higher, and we're certainly not there. So for how long will the Fed prolong this Goldilocks situation? And so Jerome Powell didn't say anything that should have been surprising. However, positioning ahead of the FOMC was a little short on that 10 years. So what did Powell say? So I see that you're showing this chart. The red chart at the bottom, the red line at the bottom, shows you this is the 10-year bond. And this is a picture of what the positioning was. And it was very, very short going into the Fed meeting. What does short mean is people sold the 10-year ahead of the FOMC in the expectation that they were going to make money because it was going to go lower because rates were going to go up because he was going to talk about inflation, even though inflation is transitory. And that's exactly what he said. However, because of the big short situation, we had a little bit of a short covering. And so it looked like the yield went down on the short covering. A lot of times we on trading desk, we say things like, buy the rumor, sell the news. It's a positioning ahead. But where the impact of the Fed headlines did do the correct move was in the 2-year. And the 2-year move, you can see that in the red line, the yield really jumped up. And why that happened was because what they said, which was not unexpected, he did discuss again, inflation was transitory. They have what they call the dot plots. And what the dot plot is a concoction that Bernanke started about 7 years ago in the interest of transparency, where all the 18 FOMC members, they put their expectations for when and how much rates were going to go up. And before the FOMC meeting, it was expected to be no earlier than 2024. That's 3 years from now. And 2 of the members moved it ahead to 2023. And again, that's a very, very long time still. Also, I would like to mention that not all 18 FOMC members are equal. Some are voting, some are not. And if the dots really mattered all that much, then Powell should have a really big dot because he basically sets the policy. So it moved a little bit, I guess, that shouldn't have been surprising, but because of the positioning that Dave showed in the previous chart, the 10-year really people took their profits because they had some profits to take. And so most of the move showcased itself on the 2-year, which is what you're seeing. And Dave, if you have the 5-year, there is the 5-year, that big line, that big move up. That's what the 5-year bond did. So yields did move up with the exception of the 10-year, which is what people like to talk about, but it's not necessarily. So it's the short end of the curve that moved up and took the dollar up with it. Now,
so Diana, in our positioning in the macro fund, we are short the 10-year, but we're also short the 5-year bond and the 2-year bond. So the 5-year and the 2-year worked. 10-year went a little bit against, but seems to have been coming back over the last couple of days. Right. But it was sort of a surprise to markets, and that caused the US dollar to rally a little bit. And that put a little pressure on the weak dollar assets like commodities and so on. What takeaways do we have coming out of that as it relates to flows? Because of course, flows matter. We've had a lot of money come into equities over the course of the year so far, and positioning is getting longer equities. It strikes me that there continues to be tons of liquidity in the market, and the Fed is not doing anything soon to take that liquidity away. I mean, raising rates in 2023, it's a long way away. What do you think? What are you thinking on flows, and what are you seeing on flows?
Great question. So the biggest story of the last 30 weeks and year to date has been the equity flows into the market. We've had $760 billion worth of dollars coming into the market, which has been really, really high. And we have $5.5 trillion, this is in the US, in savings. Money keeps coming in. And we've seen, there is, I don't know if you have, anyway, the flows have been positive every single week, with the exception of 2 in the last even couple of months. So some of these commodity stocks and the underlying commodity really rallied into this. And when they checked back, they really just checked back to support levels. Energy, for example, actually didn't really even sell off all that much. That's a play on the reopening. we're seeing flows continue to be positive. And it's across the board because, up until a couple of weeks ago, the street was very underinvested in commodity stocks. It's been an out of favor sector for, I don't know, a decade. And so it was really, really underweight. So they sold all their growth stocks, which they made a lot of money on, and rebalanced portfolios into the commodity sector. And now, once that's done, it broadened out where the tech sector that's done nothing. Some of these large tech stocks haven't done nothing for 6 months, started to move up and broaden the offering. So it's actually a better situation. And what we've been seeing in the last day or two, there's been some hedging going on in the market as that trade, that rebalancing into the commodity got a bit too much and needed to balance out. And this is actually healthy. So yesterday we've seen a reversal, an almost complete reversal of everything that happened on Friday and Thursday evening.
Right.
And today too, we had a very good day.
So we're going to make the case that what we've seen over the last 8 or 10 days looks to be sort of counter to the longer term trends. And then the question will be, are we seeing some changes? So Diane, I'm going to take them through some charts on that. Thanks so much for joining us. That's fantastic.
My pleasure.
Okay, so just to move on here, let's just talk a little bit about what's going on, just starting with the things that we look at, and just to touch back on those bonds. Higher highs and higher lows is positive, lower lows and lower highs is negative. This is the last August pricing in the TLT, and we certainly sold off a bunch, rallied a little bit, but basically rallied into the downtrend line. And for us, that's not overly significant. Now, just before we go on to that, things that should have happened if yields moving lower was something that was creating a shift, right? New strength in the bond market. And one of the things that I thought was particularly interesting was what happened in the Utilities Index, which of course acts a lot like the bonds. That's why they're called a bond proxy. And even though the 10-year yield came down, utilities sold off last week and made new lows for this sell-off that started back earlier in the year. So utilities did not confirm the strength in the bonds. And when we look at the things that made relative lows versus the stock market yesterday, a lot of them had to do with either with bonds or with bond proxies. The XLP ETF is consumer staples. The XLU is the Spider Utility Index. The VIG is the high dividend paying stock universe, the Vanguard Utilities ETF, the Global Infrastructure ETF. So these certainly not confirming that the reflation trade is over and that there's a safety trade on. These absolutely did not follow through whatsoever. So let's look at the things that happened over the course of the last week. When we look at our breadth readings, breadth model for US equities, all stocks, was strengthened over the course of the week and did not reverse lower, despite the fact that we saw some stocks pulling back within their trend. Same for all stocks globally. Canada was basically static last week, and our short-term indicators are basically all positive. So we always want to look at what's happening under the surface. Are stocks in general one by one breaking down out of their trends, or are they continuing to firm up? Breadth continued to be quite sound. It's very similar picture to where we were last year. Almost every major market is in green, and we're seeing lots of strength in credit. Credit spreads for both investment grade bonds and for high yield bonds continue to be very narrow, meaning that bond investors are comfortable with credit risk. And from a volatility perspective, even though there was a little pickup in volatility last week, just take a look at this picture. It tells the picture tells 1,000 words. Lower highs since March of last year, June of last year, September, November, early part of this year in February. Each of these spikes has been making lower highs. And so it tells us that expectations for increased volatility really just aren't there in the market. When we look at leadership themes, let's talk about this. We put this chart up over the last few weeks. This is the S&P since November of last year when the reflation trade sort of took over, outperforming the NASDAQ, the QQQ. Certainly a little better over the last 2 or 3 weeks. That's good to see. But last week we saw the metals and mining stocks coming off, the small cap value stocks coming off, the bank stocks coming off a little bit, dividend growth coming off. These are all been leadership groups. And, a little bit of an uptick just in simple price in utilities. So the question is there change taking place? Let's look at it. All stocks breadth is in a column of X's, which means that breadth is expanding. It means that of all of the companies that trade on public exchanges in the US, the percentage of stocks in uptrends is expanding, not contracting. There is not a bear market in history that started with breadth expanding. So that's in good shape. Breadth for the NASDAQ also expanding. The S&P 500 price chart has been making higher highs, and you can see pulled back to a low in June, rallied, made a new high, pulled back, retested that low, held, and again in the last couple of days turning back higher. So the price chart of the S&P 500 on a point and figure chart continuing to be strong uptrend. NASDAQ 100 bullish percent, the biggest tech stocks, positive over 75% of those companies in uptrends. And the NASDAQ price chart, again, higher lows and higher highs, that's constructive. When we take the equally weighted S&P 500, take out the impact of the biggest stocks, again, remains firmly in this upward channel we've been in since last fall. And yes, we did touch the low end of the channel, but in the last 2 days, rallying off of that. So it looks to us like we've seen some pullback in leadership, but the question is, did anything break? This is the transportation index in the US since last July, higher low, higher low, higher low, no breakdown here. And let's look at commodities. Certainly this is the GCC Commodities Index, Wisdom Tree Commodities Index did sell off over the course of the last week, touched long-term trend, and then in the last three days bounced off that. When we take the RJI, which is an equally weighted commodities index, same thing, sharp down week last week. And when commodity prices move down, it's not generally 2 or 3%, it's 8, 10, 12, 14%. But again, held the 50-day moving average and reversed back off it. Copper, probably one of the weakest groups in the last 2 weeks. The ETF sold off over the course of that period into the long-term moving average. And this was the range that it was in going back to 2014, which we just simply broke out of in February. We retested that, made a higher high. Now we're making another higher low. Again, what looks to be quite normal. When we look at the ETFs for the group, the DBB Base Metals Fund, one nice thing about a point and figure chart is it's very clear. Higher low, higher high, higher low, higher high, higher low, higher high, higher low. So firmly within trend. So we make changes when we see trends break. Trends pull back naturally. They have to. If you're in cyclical stocks that are more economically sensitive, they have a little more volatility to them. But if that's what's working, that's where you want to focus. This is the uranium chart, same picture, higher lows and higher highs. That's constructive. I get asked about gold a lot because this is one that people follow. We have to look at a very long-term chart. This was the bear market that took place between 2011 and 2021 when we broke out to new highs. We consolidated from last August. 2 months ago, we broke out of that range. And yes, in the last 3 weeks, we pulled back, but again, to a higher monthly low, continues to be constructive, but bull markets act like bulls. They try and shake you out. So the commodities indices, all of them look to be constructive. All of them had a counter trend pullback over the past 2 weeks. Should it get worse, we would certainly take some action, but we're not seeing that at this point. The oil has been probably the strongest group within commodities. And when we look at the GCC is the one that has the heaviest weighting of energy. It hasn't even reversed down into a column of zeros, which would be the first sort of pullback. So in general, this theme looks to be intact. Let's go around the world. The German market, the DAX Total Return Index, a series of higher lows and higher highs, very constructive. The France CAC 40 making new highs. We've talked a little bit about Europe being constructive because it has a higher component of financials in industrials, and they have been outperforming. Last week made a new relative high versus the S&P. Italy and Spain, same thing, higher highs and higher lows. Let's go to Asia. Breadth in the Asian markets continues to expand, sitting at 54%. Breadth for Japan in X's, meaning positive expansion in breadth. Emerging markets. Actually, emerging markets just made a new double top buy after working its way higher now for over a year. This was March of 2020, higher low, higher low, higher low. First sell signal in an uptrend is almost always false in a point and figure chart, which of course it was. And we continue to work higher. This is the PIE ETF, just sort of consolidating sideways over the last 2 weeks. So global markets more economically sensitive than the US market. We've been saying for a while now, it looks to us as though international markets could outperform the S&P. That has been the case over the last few weeks and continues to be very sound. Shanghai or Chinese breadth has been expanding since February, continues in a column of X's. Latin American breadth expanding. So really equities around the world continue to behave really constructively. This is the Brazil Bovespa, higher highs and higher lows. This is the Mexican market, same picture. So equity asset class looks to be sound. Commodity asset class looks to be sound. The fixed income market continues to look weak. And when we look at those things that made relative strength new highs versus the S&P, of 6,000 ETFs, 2 made relative new highs yesterday. One was the US Oil Fund, USO, which tracks US oil futures. And good for our home market, the S&P TSX 60 index made a new relative high versus the S&P, which would explain why we have more Canada than Canada represents in global markets, because the Canadian market really is outperforming many other markets. So just to touch on a couple of these points, this is a relative strength chart, the Russell 1000 Value ETF versus the Russell 1000 Growth ETF. We had a little pullback in value that took place in April. We had another little pullback that's taken place over the last 2 or 3 weeks. And when that happened, the bond yields pulled back both times and held this longer term support. And it looks as though the momentum for value is now ticking higher. So we put that against the longer term picture of what's happening internationally, German bonds versus US government bond yields. Global yields are moving higher faster than US bond yields. That tells you that investors believe that economic strength is coming in global markets as well as the US. It's not just a US function. And when we look at seasonality, seasonality is important for commodities. June and July tend to be strong months. Actually, July tends to be the strongest. So it's a good time for it to have pulled into support and be turning off. In the last couple of days, companies like Freeport and First Quantum have had very, very good days. I think First Quantum was up about 4% today. So value versus growth, the S&P value ETF versus the S&P growth ETF, we can see that we're getting some strength in both over the last few weeks. And certainly value pulled back a little last week. Growth had a little extra push, growth pulling back here, value reasserting. It's healthy that different themes are working, but there is no rotation that we can see in place. The longer term picture is that growth has outperformed value for a long time. This is probably very early stages in this shift and should go on for a long time. So our job basically is to focus in market leadership. Our job is to identify the key groups that are seeing net inflow of funds, where breadth is expanding, and focus our attention in those areas. We don't have to be in every sector. We look for new opportunities when new breadth starts to improve. And we've started new positions there. So we were very heavily focused in US stocks. Then we broadened to Canadian companies. Then we broadened to global equities. We broadened to commodities over the last year. And we have avoided all of those bonds and bond proxies that are showing weak relative strength. If we saw those breadth models turn down, you will see us raise cash. You will see us exit sectors that have started to deteriorate. But at this point, our holdings really aren't changing very much. In the past few weeks, we've seen a little more strength in tech. So we bumped up our tech weight from quite a low weight because it had underperformed for several months. That's a positive thing, new breadth taking place in tech. We took down our industrials weight a little bit, took down our financials weight to do it, and took down our materials weight a little bit. We'll see if they reaccelerate, but basically we continue to be very focused in economically sensitive sectors, reflationary sectors, and at this point don't see any reason to shift that. The longer term picture continues to be quite favorable. We get asked all the time on currency. I think that the Canadian dollar trend is clearly higher. It's quite tied to commodities, so it shouldn't have been a surprise. The CAD sold off a little last week and then seems to be finding its footing and shifting back higher. And so that means that we're going to continue hedging our currency exposure on US positions back to Canadian dollars to make sure that we don't get hurt from a currency perspective. So look, if some of these breadth models were start to change, or some of the sectors that we're focused in started to break support, you would see us shift our holdings. But at this point, it's not necessary. We're pretty good over time at managing against tough markets. This is the bear market, 2001 and 2. Had a good move through that period, through the financial crisis, held in pretty well by getting defensive early, and certainly the same thing in 2015-16 when Asia slowed down and knocked the pins out from energy and commodities and so on. But at this point, it looks to be sort of steady as she goes. The end of June historically can be a bit of a sloppy period, so it's possible we have another week or two of bumping along, but we can't see that any of the key trends have shifted. And so we look forward to a summer rally in July and the beginning of August, and look for the next sort of 4 steps forward. With that, Pam, if there are any questions, certainly we can take them.
Thanks, Dave. And thanks, Diana, for joining us this afternoon. David, it was a great overview by Diana on the dynamics with the bond treasury markets. Can you give us a sense if there's been a material increase in the energy weighting in the various, well, specifically in the global macro strategy that you manage?
Yeah, so different than some of our other pools, we are less concentrated in energy. We do have a significant weight. So to put it in context, in the S&P, energy makes up about 3.5%. In the TSX, it's about 4% of the TSX. I'm going to say that we are about 8.5% energy in global macro, where in our equity portfolio, I think it's probably closer to 17 or 18%. So it's a pretty big weight there. But that's because in the equity portfolio, there'd be a lot less exposure to things like emerging markets. So global macro has a bigger weight in various global markets, including Taiwan, Korea, Mexico, China, of course, Japan, and the EU. So those all are a play on the global reflation that are slightly different than just sort of the energy trade. It is unclear whether the strength in energy is just purely cyclical, a global reacceleration, or something bigger. Obviously, there are headwinds to carbon-based energy, but in the near term, it looks like a good place to be. We just have a lot of different themes that we can focus on. Overall, in macro right now, we have a relatively modest US equities weight. We have a pretty good basic materials weight, the building blocks of the recovery. We have a pretty good exposure to both developed and emerging markets. And we do have short positions in some bond and bond proxies and the US dollar.
Thanks so much, Dave. We've had a couple questions on financials, and specifically your thoughts on choosing Canadian financials versus US financials. Right now, especially given the recent correction, where would you like to park your money? Where would you suggest our investors do so?
Look, we like both Canadian financials and U.S. financials. And let me just see if I can share my screen for a moment. So if we were to take a look at the Xlf Index, which is the U.S. financials ETF, and this encompasses all areas of financials, and take a longer term picture, you can see that, we just really have just come out of this bear market that financials have been in since 2007. So we've had 1, 2, 3, 4 months since we exited that bear market. And my guess is that this is, going to go on for a very long time. We will have some news over the next few weeks on the Fed's allowance of U.S. banks to raise dividends and give capital back to shareholders, buy back shares. That should be positive for various large banks. And so, they had a little pullback, nothing to speak of, certainly nothing breaking down. If we look at the Canadian banks and we look at some of the more important ones, they've held in a little bit better over the last couple of weeks, a little bit less impact from some of the Fed comments and the pullback in yields, but they're more expensive for sure. So we like the current Canadian currency. The Canadian banks are certainly more reliant on the real estate market, which we know is pretty hot. So I think that there's pluses and minuses to both. As far as insurance goes, the insurance group looks quite good, although it backed off at the end of last week. Again, still relatively early in a long cycle upwards. And the investment banks also, had a little pullback. So I think that they're good for various reasons. And I know that in the equity portfolios, our focus has been on the growthier banks that are growing their loan books a little bit more quickly. Because they've been sort of outperforming. So there's lots of things to do in this area, not excluding fintech. There's PayPal. It also looks quite good.
And pivoting from an uncorrelated asset class to the market, David, would you be able to briefly comment on the growth and success to date of our music fund? I know we've raised almost over $25 million for that fund. So maybe you could comment as we continue to repatriate the rights of Canadian musicians in a way that no other Canadian fund manager is doing.
Well, listen, this is a lot of fun. It's something that we've been at now for 6 or 7 years. Our first fund was quite successful and was a small one. And this one, I think, will be quite a lot larger. We'll be raising funds, for the next several months. But it's going quite well. The big problem for income investors right now is that you need to own some things that can do well in rising rates. And we all know that streaming, people buying subscriptions to music services, is still very early stages and is, going to be in the billions of subscribers going forward. And Canada has been really at the center of the winners in streaming. I think 3 of the top 10 streaming artists in the world are Canadian, including Drake and Justin Bieber and so on. And so we've been successful in buying some interesting catalogs. As you know, we bought a lot of the top songs from The Weeknd through the songwriter Belly, and we've got another catalog that is coming that will include some copyrights for songs by Drake and Dua Lipa. And so it's very, very interesting, and the assets are cash flowing 8 to 9%, and streaming revenues are growing, and so it's rare to find income assets that have a nice growing revenue stream, and it's getting well received. So certainly something we like talking about.
Thanks so much, Dave. And Diana, thanks again for joining us. That concludes our questions for today. And of course, we look forward to seeing everyone back here next Tuesday at 4 p.m. With that, David, as always, I leave you with the final word.
Sure. So listen, if you have topics that you would like us to cover or questions that you have and you want to send them to us prior to the call, certainly don't hesitate to ask us either through Twitter at my Twitter handle, which is at barometer.ca, or whether it's through our website, or whether it's through one of our investment counselors. Happy to certainly jump on any topic. And hopefully we'll have an uneventful end to June. And if things change, we'll probably publish something in between calls. But in the meantime, let's all try and enjoy summer and being outside and seeing our friends. So thanks very much for joining us today, and we'll hope to see you back again next week.